Are you wondering how real estate can be used to build real wealth? It's called the snowball effect, and in this video I'm going to walk you through how you can use the snowball effect to build wealth through real estate. So make sure you hit the subscribe button right now so you don't miss more videos about how you can build wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about the snowball effect in real estate investing. And we've probably all built a snowman at some point, especially if you're in the colder climate like me in Canada. So we start with the snowball. It's always a little bit of snow in our hands, and we crunch it together, and then we start adding more snow, packing it together, and pretty soon we're rolling it on the ground, picking up more snow, and this little small snowball turns into a big large ball, and then we can build our snowman or snow fort. Well, the same thing happens in real estate investing. All we need is that initial small piece of snow, and we can really roll it like we're rolling the snowball and build this big, large portfolio, and that in turn creates large generational wealth, which is why we're all doing this. And with wealth comes time freedom, which is why most people invest in real estate. So I'm going to walk you through an example right now of the snowball effect in action, and this works both whether you're passively investing or if you're actively investing in real estate. Passive investors, I've done lots of videos before about how they can passively invest in these large apartment deals, and then actively if you're acquiring properties on your own, or maybe you're the general partner in a deal, the same thing applies. It's the same either way. So let's say we invest $100,000 in our first deal. So I'll just do $100,000. And we use the value add approach, and I'll put a video up here for the value add approach, and we really force that appreciation in the property. And whether it's 3 years later, 2 years later, 5 years later, at some point we're going to earn the return, and we're probably going to get a 2x on our money. So this $100,000 turns into a $200,000 chunk of cash. So what we do then at that point is we acquire two properties. We put $100,000 each in these two properties. Now, some people at this point will say, well, instead of acquiring two properties, maybe we acquired a 50-unit property, maybe now I'll just go and acquire a 100-unit property. So you're doubling the scale of units. That also works, but in this one, we're going to keep it simple. So we do the exact same business plan for these two properties. We find a good property, strong fundamentals, good market, and then we force the appreciation. We add the value, whether it's through reducing the expenses, improving the NOI, bringing in good business operations, and then we end up with $200,000 lump sums of cash. Well, the same thing can happen again. We have $100,000, and then we have another $100,000 here. So from this one property already, now we have four properties. And then it's going to double again. So then we're going to have 100, and it goes on and on and on. Or, like I was alluding to before, you can start at 50 units, scale up to 100 units, scale up, now double again to 200 units, 400 units, then 600 units. The same principle applies. We're taking that small snowball and we're rolling it on the ground, acquiring more snow. And what's really interesting with this is just us starting with $100,000 cash. Now, this is the slow way to do it, where you're just investing $100,000 and then you're slowly picking up speed and as you roll that snowball. Now, let's say you're a passive investor, so you are investing capital into a large apartment deal. This is just the one deal. Well, what if you invest in a deal once a year or once every quarter? This, obviously the timelines really compress and they get really interesting really fast. Same thing if you are on the GP side, if you're doing your own deals. Well, once if this is just one deal, what if you start acquiring other properties and you raise capital from passive investors, and then you can use their capital and earn them really great returns, but also you're building your portfolio. This compresses this again, and then things get really interesting because all of a sudden, instead of having one property start the snowball, maybe you have three properties start the snowball, and of course this repeats itself over and over again. So this is the snowball effect idea with real estate investing. It starts with the small piece of snowball. It just takes one deal. That's all it takes. One deal to get you going, and then you'll start picking up speed and steam as you go. And you know, your first deal is not going to be the easiest deal because you're going to be learning a lot. Your second and third deal won't be the easiest deal, but as you get going with it, same with passively investing, you're going to learn a lot doing your first deal, and then as the snowball grows bigger, you'll become a professional investor. If you're interested in learning more about the deals I'm currently doing, head on over to callseth.com and set up a quick 20-minute phone call with me so I can learn more about your real estate goals. And if you like this video, if you found this useful, leave a comment, let me know what you think, hit the like button, and until next time, happy investing.